Hey,
Hey,
good morning, Mr. Sir. How are you, sir?
good Albert. How are you today?
Doing very well. A lot of interesting stuff going on today in the world. I mean, it looks like we have a peace deal in the Middle East. Those are great news. So a lot of good stuff.
Telling you,
A
that's
lot of
been
good
going
stuff.
on for thousands of years, right? It's like,
This
man,
is
it'd
this
like
is
to have
true.
some peace, right? Yeah, we got baseball going, we got
We do. We
playoffs, we
got
got
football. We got
football,
football. We got baseball. I mean, maybe the Raiders
hockey.
come back.
I mean, this is like a great time of year. I mean, I look at October. In October in the mortgage business is typically pretty good, right? So everybody's back to school and does those type of things. So I'm hoping that this is all good for everybody out there, right? As we go forward to close out 2025 and then start 2026 again. So I'm
Amen.
kind of excited. You're there, right?
Yeah.
Yeah. Time flies.
I mean,
It sure
literally
does too
a
fast.
week, then we're right into Thanksgiving, right? Which is probably my favorite time of the year. I would probably say that's my favorite holiday. But
It is one of mine too.
yes, sir. But with
Yep.
that, Greg Fairman wants to say the Commanders are looking good.
Yeah, I guess.
I guess, sir. Hey, Debo Samuel, that's my running back
All
in my
right.
fantasy team, so he's my guy. So with that, hey, again, we want to thanks everyone for attending. Thank you for attending another Home Express webinar. And our topic for today is going to be cash out options for non-QM, right? And pretty much what we want to do is set you guys up for Q4 and really get you set up for Q1 of 2026. A lot of changes are coming, at least from what we think that's going to happen in the market, and we just want to offer you some more knowledge and get you prepared for the end of the year, beginning of next year. So as always, we want to thank you for your participation. And with us today, we have Mr. David Greider, who is our Senior Vice President of Sales here at Home Express, myself, Albert Martinez, who is your corporate trainer, and our special guest today is Mr. Dave Nelson, who is one of our top RSMs here in the company. So with that, Mr. Greider, I'll hand it off to you, sir.
Oh, thanks, Albert. Thanks for the introduction. Thank you, everybody, for joining. I just kind of point out a couple of things. I am not an official spokesman for Home Express or our parent company, Chimera, but as I go through, a lot of this is going to be my opinion. I've been doing this, I'm going to say at least 10 years. Actually, I've been in the business probably 40. Kind of saw the ups and downs in the market go here. But as we go through, and we'll go through the agenda here. It's really trying to look at, and I try to look at what's the market doing, right? And what do I see empirical? Because we see all the submissions that come in and the fundings. What does that look like? And what can I provide value to our clients on where's this going and maybe how to solve some of the things, right? So we're going to look at the cash out market. Right on the refinances. I'm also going to take a look at the NBA forecast, look at trends on that, the state of consumer debt, as we go start throwing some options for you that doesn't fit traditional financing, whether from through the agency world that might fit the non-QM. And then we're going to look at that. And everybody gets a copy of this deck. There's some of these slides that got small print. But I wanted to put it on there because we'll send the deck out to you plus the recording to all those that registered for this webinar. So welcome and thank you for joining today. So with that, Albert, I'm hoping you got a poll to start us out with, man. I just love polls that you do here.
I know how much you like those polls, and we definitely want to know what the masses think. So it being October, which is playoff time in baseball, who do you think is likely to win the 2025 World Series? Do you think it'll be a first-time winner, which is going to be the Mariners? Do you think it's going to be a pastime winner, right? Which could be, Brewers, Phillies, the Blue Jays, Cubs, or the Tigers. The Yankees got knocked out yesterday, and then we got some more games today. Or do you think the Dodgers are going to repeat back-to-back champs, right? So I had to kind of separate them because, it would be back-to-back, which would be pretty interesting. So what say
Would
you,
be.
the masses? And they are voting. What do you think, Mr. Grider?
Well, I'm going to go with the middle because my odds are better because they got what five teams there versus two one of the other ones. So if I go in
Right.
the middle, I got higher odds and probability of getting that.
There you go.
That's the only reason
Now,
why.
you would hit
Well, for
that.
me, I'm not a Dodger guy. I'm voting Dodgers. They just seem to have it all together. And even though it said I
Good
can't
team.
vote, I'm throwing it in there anyway. So
There we
All
go.
right.
So the masses think they're with you, Mr. Grider. They think it's in the middle, right? So
All right. It's a good team here. They
it's
got
a
the
pass
math
winner.
down, right?
It's a pass
there's
winner.
only 28 votes. There's only 28 votes. let's get the vote out here. Everybody needs to vote. You can't complain if you don't vote.
We did that. We could be waiting a bit, right? So
Fair enough. Okay.
All right. Good one. All right. So the first thing I do is like, hey, I've been doing this kind of periodically, but I might start doing this all the time, is kind of ask ChatGPT or what AI has and of the state of the mortgage market, right? So we typed in something like this. It's like, I think Albert's got something on here that what are the mortgage loan statistics for the first half of the year, right? So that's what we typed in. Let's see what it says. Now, it's not the one all everything, but it does take a lot of data and it comes back what they can find on it. So it at least gives you trends of that type of thing. So we just want to cover this a little bit, what it is from the first half of 2025. Okay. So here's a breakdown of loan statistics. Refinance loans, man, that was 40% of all loans in the first half of 2025. And typically the first half, especially you get to March, April, May, is a purchase season. But man, that's a big percentage. That's why we're having this topic out. Out of those refinances, nearly 60% were cash out. Then you kind of look at, kind of the refi amount, in the first quarter of 2025, they had that data was 45 billion of equity kind of withdrawn from that. That's a lot, right? And I think we're going to see that going forward as well. And we're seeing it here in the back half of the year as well. And it came up with this borrower's profile. Okay, great. Let's look at the borrower's profile here who opted for a cash out refinance. Had a lower average credit score, and you were saying 719 versus higher rate in terms of smaller loan. I think Dave Nelson had a few comments on that. 719 seems like a good score, right?
Yeah, I do have comments
typical
about that. I think our score is even higher than that. That's that AI statistic, but you wouldn't think so on a non-QM loan. You would think that these are scratch and dent kinds of loans. Anything but. These are good borrowers who just have a story to tell, and we're making those loans work. So that's correct. It's good borrowers, and I am surprised with those numbers.
Yeah,
but not anymore. I'm not.
Exactly. Higher interest rates, another category here, right? 70% of the cash out refinance, the borrowers accepted a higher interest rate than their previous one. Okay, that's probably true, especially if they got it during 2021. The average rate increased almost 150 basis points, right? 1.45 percentage points higher than the borrower's original rates, right? Kind of typical. So their payment went up because the rate went up and they took more cash out, right? So what's the reasoning behind this, right? It's to access the cash to kind of rearrange their current financial system, or where they got debt, right? We'll take a look at some of the debt loads. Maybe they need to cash out for, their kids' tuition at school, lots of things, but they're trying to rearrange because inflation's hit hard. They're looking at, if you ever looked at some of the rates on credit cards and some of the auto loans over the last 2 or 3 years, you look, hey, man, this could really save them some money. And we're thinking, my thoughts are that a lot are taking these out to rearrange their finances to get into a better position for their family. And they're also looking forward because they're believing rates will trend down. So this might be a 12 to 18 month loan when they're looking at refinancing and doing a rate and term after that to put them even in a better position. So that's what I'm
Dave,
forecasting.
If I could interject on that too, it's, the loans need to have purpose. If the loan has good purpose, just like you're mentioning there, you don't mind a payment. The consumer doesn't mind a payment going up if there's good purpose with the loan. And that's our philosophy in lending too. I know I'm stealing your thunder a bit, but good purpose in lending is what this whole slideshow will boil down to.
Yeah, net benefit to borrowers, very important. All right. Let's take a look at some other market statistics as you're going through this and trying to give you value. But this is the MBA forecast. I got 2 of them here. And go, why am I choosing April 11th? But, well, I just wanted to show you some things right here. And this is all the forecast for MBA, and then they have to kind of redo things as they go along. But in the gray section is 2024, and I'll just go over there. The total first mortgage volume, this is them telling us what we did in 2024, is 1.78 trillion in volume. Right, you're going to think, okay, that was actually historically very low, right? But they had to recalculate that. So when we go to the next forecast, and you'll see on 24 refinance are low, they changed it to 1.68 trillion. So nearly 100 billion less in mortgage volume after recalculated it. So as you know, if you're saying, if you look at the economic news, Bureau of Labor Statistics, all these revisions down, we even had a revision down from the MBA from 2024 that was done in August of this year, revising it down. But if you look through these numbers, we're seeing that refinance category really starting to jump up this year than in 2024 as a percentage of the mortgage market. So it's really kind of a trending for you, so you can look how the trends are go. And thank you all for still being in the mortgage market and understanding that the mortgage market has its ups and downs, right? 2021, great year, tons of volume, rates were low, everybody wanted to buy a house, and then you go through other times, right? It's been that way, very cyclical type of industry. So when you have good years, you save a lot because you know you're going to have some years where it's hey, there's less transactions out there, and we kind of see that. So everybody on the call, thank you for doing that, kind of understanding that, and appreciate you guys sticking in this mortgage market. It's a great one. I've been doing this, for almost 35, 40 years now, and love it and love helping out consumers, and just like you do. Let's take a look at some of the consumer debt, and I'm trying to give you some forecasts of just really trends, right? So the trend. So I wanted to look at Q4 2024, what the household debt and credit look like, and that household debt was approximately 18 trillion, right? Just slightly over that. In the blue is the mortgage debt, or that type of thing. Then the rest is the other debt. And this is from the New York Fed. You can pull it up anytime there as well. Then I thought, what's the trend, right? So it's good to look at something. Where is our trend in the debt world? So the next slide is going to have a little more up-to-date trend on debt. Here we go. A little bit different format they had from the New York Fed, but in the yellow down below is the mortgage debt, right? So that's mortgage. Then you get into the other debt. The big thing to point out is 18 trillion. Now we're at nearly 18.4 trillion, right at the midpoint of the year right here, right? So if you start looking after how's it's going, its trajectory is still going up. And I think a lot of people are struggling paying off some of their consumer debt now. And in the refinance market, you could help with that, especially in the consumer purpose side. So that's the trend, right? So we know there's a need out there. We've seen where that's going out there. So we'll take a look at how we can help out that with some solution for those that don't fit their traditional guidelines.
Well, you know what, Dave, this really shows that the consumers are looking for access to capital, which is one of the reasons why we're having this presentation today, because that's
Right.
where our trends are going to. So,
Right. The other thing is why non-QM's a solution here, because very high refinance rejection rate, very high. And I looked at this article and I'm going, man, how do we solution for that? At least get the awareness out there that some of these rejections probably could have been loans in the non-QM arena, right? So let's take a look at the kind of the most common reasons that they listed from this report. Next slide. There we go. Right. So the top reasons that they stated here, and we'll kind of look at this, right? You have credit issues. Okay, that's kind of Captain Obvious, right? Yeah. Hey, dude, your score is too low, has mortgage lates, has consumer lates, or whatever that happens to be. Maybe there's some credit issues, right? Income shortfall, right? That's probably up there too. High loan to value, so it doesn't quite fit the cash out refinance or the refinance options. Fair enough, right? That could be true, right? Not enough equity. But by the way, there's tons of equity out there, but that's still a reason if they have that. You're trying to finance an out of favor property. Okay, maybe it's a rural property, something of that nature, condotel, right? What kind of property is that that's out of favor that maybe we can help you with, right? So my key takeaways, I just highlighted one. If you can read this through the deck or click on the article, but mortgage underwriting is often an automated process. Well, not at Home Express, right? It's like our first page of our guidelines. We look at every loan on its own merits and try to help them out the best we can. So tell us the story. Does the loan make sense? Can we help them out? It's got a true net benefit to the borrower, right? Then we can document that they can pay it back. You'd be surprised how we can help out a lot of these borrowers that fall into this. I know, Dave, you're talking to me. You had some comments regarding this too as well, right?
Well, I mean, my comment is these are the reasons why folks come to Home Express. You know, can you salvage this problem loan that somebody else has turned it down? And again, you did go over those already, but we're problem solvers, and if we objectively can come up with a good rationale for lending money to these folks, we'll find it.
Yep, good point. Okay, so kind of looked at some of the reasons here. Let's look at some of the non-QM options here, right? So when I look at non-QM programs, I fundamentally put them into two categories. One is consumer purpose, that's your TRID loans, right? Primary, second homes, or the purpose of the loan would be consumer purpose or personal purpose, so that would be a TRID loan. Also, the opposite, business purpose, right? That's non-TRID, they're doing with that. And we've seen a big uptick in cash out on the rental properties. And the small to medium investor is really looking at, hey, during some of these economic slowdowns, they're looking at ways that they can get into areas to increase their portfolio and look for cash flow on properties. Or you have some that looks at, hey, the stock market's kind of frothy right now. What can I do? Maybe I should look at real estate or some hard assets to acquire on it. And we've seen that as well. So we do have, the DSCR, that's your cash flow program, right? We have very streamlined guidelines on that, and where you can get up to 80% on cash out on that with a good score and a good over 1 DSCR. We also have the short-term rentals. That's still a big market, especially in high density areas of resort type areas. That is great. But we have these options for you, right? Keep in mind that if you do business purpose, 51% of the proceeds must be used for business purpose, or you got to afford TRID and go to a DTI or asset type of program. We'll go to the next slide, Albert, and we'll take a look at the states that you're licensed in or don't have to be licensed in. And I always show this because we had a few of our clients over the last few years really grow their business network, marketing to those small to medium investors in states where you do not have to be NMLS licensed, right? So everything in the dark blue here, you do not have to be NMLS licensed to do a business purpose loan. Kind of expands kind of where your market is. So if you're an LO in California and you have clients looking at cash flow, what do I do? I'd like to get some rental properties. Man, there's some good areas in the Midwest or even maybe in the South. You've got to be careful where you're at there. But they're looking at that. Maybe they can get their cash flow a little bit better than you can, like in the Bay Area of California or Orange County, right? Lots of different ways to go on this. But as you saw on a slide a couple webinars ago, some of the bigger increase states, believe it or not, Montana was on there where small to medium investors are going to buy rental properties. Kind of surprised me, but that's why I kind of look at this data where they're going to some of the Midwest, some of these other states, looking at opportunities for cash flow. We'll go to the next slide and kind of just real briefly kind of go over some of the highlights of DSCR full doc options for the business purpose. Some of the reasons we talked about: down payment to expand a rental portfolio, upgrade their existing rentals they have to increase the market rents. Then a little bit tidbits of guidelines. I mean, we have streamlined guidelines on your business purpose DSCR, right? Where you don't even, most times don't even need lease agreements to qualify. We can use the 1007 or 1025 of its units. We know the 1007 has actual and market rents on there. So very streamlined conditions regarding the DSCR program.
That's a really big deal, Dave, that not requiring leases. And the flip side to that is that we can use leases if they can document a history of having received a higher than the market rents. So as far as that goes, we can work it either way depending on the circumstances unique to that consumer. So
yeah. So if you have somebody out, this can help you expand. I mean, there's these small to medium investors have networks. If you can get in with them, that's great. And then you can be the go-to person. Hey, we can take this property, refinance it, get into that one. And these go fairly quickly since it's non-TRID. There's no LE, CD requirements, all that kind of stuff, right? So keep that in mind as you're out there marketing, trying to grow your existing business, book of business. We'll go to the next slide, cash out consumer loans, right? These are TRID loans, right? Because the purpose is for the consumer or personal. We focus on the self-employed because that's primarily how non-QM started, right? Is what'd you do with all these self-employed borrowers who had to be approved with tax returns and they didn't meet the liquidity? They had a great tax accountant that wrote off all these things, but they had great cash flow, great assets. And what happened to them, right? So keep in mind that even if they could go tax returns, there is no pricing difference between going 12-month bank statements or full DACA non-QM with us. So keep that in mind that it's probably easier just to do the 12-month business bank statements, get it done. Other thing is loan amounts. If you have a loan amount over the conforming limits, I mean, there's some jumbo, prime jumbo pricing, but you also got to look at non-QM. We have both those programs available to you, so kind of look at that. Credit events, we talked about that as some of the reasons for rejection, right? We can do some loans that make sense because they had a blip in their credit, whether that's a mortgage late, a bankruptcy a year or so ago, something that happened in their lives. We can look at, tell us the story, and we can help you kind of do that. We looked at the assets to qualify, asset depletion. So we can structure your loan with a lot of different avenues on that income, right? Where maybe the traditional finance can't. Well, they have a side business and we can't use that, does not enough on, they write it all off on their tax return. Well, maybe we go W-2 paycheck stub and grab their 12-month bank statements from that side business, add that on, and it qualifies. Oh, then we can even add in asset depreciation. We call it Asset Express here, but they have assets, divide that out. That could be part of their income as well on qualifying for DTI. So again, the last bullet point, jumbo pricing, very competitive to jumbo prime. Kind of depends what LTV and FICO bucket is, but sometimes even non-QM is better price than the jumbo prime out there today.
Hey, Dave.
Yes.
I just want to, regarding the loan amount bullet point that you have on there, we don't begin with our LTV or loan to value adjustments and another ratcheting of adjustments up until $1.5 million, 1.5 million.
That's
So
correct.
we're talking about larger loan amounts. It's not from 358 to 4. It's all the way to $1.5 million. And for those out there who are doing the larger loans, $1 million loans, that's a big deal. And we're seeing more jumbo loans on our team than we have ever before. So
Yeah, good point.
mhm.
Okay, Albert, what do we have next here, right? Standard expense factors, right? So I just want to kind of put this out to make it kind of the speed, ease, and convenience factor for you that most of our loans, you do the 12-month bank statements, do not need a tax account letter for anything. We're a common sense, makes sense, underwriting type of operation here, right? So expense factors are based on the business type. So you kind of have a questionnaire, kind of tell us about the business. Here's your 12-month bank statements. We apply a standard expense factor, and we can do that before you submit the loan, or kind of just put it in there as a scenario in our portal, upload the bank statements. We can let you know the income up front, right, as you're progressing with that loan application, right? Which is very helpful, and it's done usually within hours. So really help you out with that. So standard expense factors is a big deal, and it goes from 15% up to 90, and you go 90, that's a high expense factor. Well, we look at some business bank statements that have 10 million a month going through there. Why? They're a manufacturer company, 800 employees, right? Those type of things. Oh, when you have a 90%, 10% of that's income on $10 million, what's that, $1 million a month? That's a lot, right? So don't let that go there. But then you got the work at home type of business, which we have very low. And we can always use the tax account letter if needed. But I just wanted to kind of point that out to you.
Mm-hmm.
What else we have, Albert? Next, we talked about some of these solutions. So we know kind of some what the top 4 that they listed out, right? Credit, right? Okay. On our consumer purpose, we go down to 600 score. That kind of opens it up a little bit for you, right? Talked about the income. Hey, don't have to use tax returns, use the bank statements. We even have programs with DTIs up to 55%. That's with high residual income. We have the programs for the credit events, right? We can get the cash out to 80 LTV, right? And that's both on the consumer purpose and our business purpose. This talks about non-owner OC properties for consumer purpose. That's refinancing that non-owner, but the purpose of the loan is for the cash out to be used for consumer purpose. Interest only and non-QM is available to even lower their payment. And we have very competitive interest rates given the pricing adjustments with the agency. So I'm hoping all this can do it. But the big thing for you is like, just tell us your scenario. Talk to your highly trained account executive. We're going to be able to structure these deals for you, kind of put that together. I may ask a few questions that you're struggling. Why didn't it fit agency? Kind of to know that. And we can help you structure that deal to get that deal closed. And then you can have a repeat borrower in 12 to 18 months. Hopefully, as rates go down, that's just my opinion. I think they will. I think we're going to have a 12-month period where rates are going to be very, very favorable for us. Okay, Albert, do we have like another poll? That'd be great right now, I think.
As a matter of fact, we do, Mr. Grider.
All right.
We do have another poll. So considering everything that, is going on right now with the government, and knowing that sometimes the government being shut down can affect how the ability to be able to close some of these mortgages. So how much longer do you think the government will remain shut down? Would it be a week? Would it be 2 weeks, 3 weeks, 4 weeks? Maybe never. Right?
That's why I said it. It's like, hey, is there never bucket? No, but I think by the end of the month. So I'd say 2 weeks. But man, this does make it difficult, right? Try getting a 4506 back, or all these different things that you don't even think of. What if there's a natural disaster or something of that nature, right? It really can affect us. I hope they get their stuff together and come up with some solution here to get us back on track.
So it looks like the majority of the people think 2 weeks.
I like the group that said 4. Go forever.
We
could have put 4 months on there, right? 4 months. I have no idea, right? So I'm hoping they get it done. So on our next thing,
we had more voters. We had the more voters I was asking for at the last poll.
Yeah.
All right. Well, Home Express is traditionally been 10 years now, right? This is our 10th anniversary month, right, of non-QM. But over the last 2 or 3 years, we've added a couple products in, and that's going to be FHA, VA, Fannie, Freddie. We have Prime Jumbo, a non-owner AUS. And I looked at it and go, why am I going to show this to you, right? It's because we're doing this for our clients because we have very low margins on our government loans for sure, right? Because we're primarily non-QM company, so we're just add this additional benefit to you if you want to broker out or wholesale FHA or VA loan out, right? And try to look at our pricing. So I thought I'd just give you an example of that. And this is really kind of picked up with a lot of our clients. Hey, I didn't know. We're on Loan Sifter, Lender Price, of course, our portal, you can price at LoanX. So if there's a different pricing as you like, please let us know in the chat. Love to know that. But this is just an example. It was pulled out a day or two ago of a FHA cash out, 80 LTV, 680 FICO with a rate of 5.875, right, on Loan Sifter. We're actually number 2 on that list, right? It's at over 2 lender credit, 2.137 lender credit at that rate. So you can see we're highly competitive for that. I call it the vanilla FHA loan, right? So we can do some manual underwriting, but this is really set up with low margins, so it's kind of vanilla. But if you have that, you should check out our pricing. Then I have another example.
Another interesting trend, if I could, is we're actually picking up more non-QM business from our mortgage broker partners because of the pricing on the FHA. Some of the customers out there are shopping all sorts of different lenders for the lowest possible rates, and like it says on this chart here with Loan Sifter, they're finding that we have some of the lower rates, and then they put their toe in the water with Home Express. So you know what, our non-QM business should go there too. So the point of interrupting you like I did was to show that we're actually getting non-QM business off of our agency loans, which was unheard of years ago. And just wanted to point that out because I'm in the field. So I see this stuff and it's a big deal. So it's sharp. Yep.
Let's look at the next slide. And this is just an example of VA, right? So this is a VA cash out, 85 LTV, 720 FICO, put in 6%. And I don't need to go through it. We'll show it out to you, but this is a snapshot of time, as you know, on pricing. We're actually #1 priced on Loan Sifter on that. So it's just an option for it. We're not here to take any loans you do in-house. If it's in-house, keep it there. But if you can broker out, that's what you do on these products. Man, give us a call. Check out our pricing, right? You can let us know if you need the portal logins. You can use that. You know, can't submit a loan until you're approved with us, but you can have logins, and we can share that with you of how that price and how our portal works. All right, expanded, right? So I thought I'd just take a look about just some different things, right? So on the cash out side, right? Seasoning. Seasoning to us in the non-QM is a valuation concern, not necessarily a chain of title event, right? So that's what I do. It's like, can you do a cash out transaction? They own this rental property for 2 months, right? Yeah, okay. Well, I understand that, delayed financing is kind of a difficult word, but what if they bought the property for 200,000, put 50 grand into it, and you have your new appraisal at 320? Well, it probably makes sense to use a 320 value, right? And give them their cash back that they put into it and all that stuff so they can go on to the next. We're okay with that. So we really look at it as what valuation we're looking at, not necessarily the chain of title. If you go to agency, it's a little bit different, right? Where you got chain of title. If you owned it for 6 months, that's not what we look at. Look at what you buy for, what you put it into. Does that value make sense? We take a very makes sense approach to this. So we have programs for less than 6 months on title. Property types allowed, right? That was one of the concerns. Out of favor property. Well, what is it? Is it rural, short-term rental, non-warrantable condo, high-rise, condo-tel, all those things? We have options for you on those properties. Cash out limits, right? Unlimited under 65. We'll probably have really good LOE if you want over $1 million cash in hand. But if it makes sense, we do the deal. 500,000 for our LTVs. And again, the reminder, we have 80% cash out LTVs for both primary and rental properties. Okay, Albert. I'm going to let Dave handle some of the examples. We always like to give you a couple examples of closed transactions, kind of give you a favor, just a flavor of what we do and some just typical ones we get in.
Sure, I can expand on this, and I'll resist the urge to read that entire slide to you.
Thank you.
But but the real point of this is really what you had addressed on the last slide, which is, does this make sense? We do not want to participate in speculation that a real estate investor wants to do. In other words, we don't just fund their next purchase. We would like to replenish their funds, as we did in this example, as you can see here. The date of November of 24, that could be September of 25, and we would take a look at doing this particular transaction because you don't have speculative appreciation of the value. We could see that these kinds of improvements would marginally appreciate the property, marginally enhance the value of the property. And we're comfortable with that. We understand real estate. But the real point of this is, if we can tangibly look at some of the work that was done and is a modest and reasonable appreciation of that value, it's not going to affect the putting stick in the spokes, if you will, of the turning of the wheel. We look and we do these properties and these loan types. So that's really the point I would come out with this slide.
Thanks, Dave.
Yeah.
I think we've got another example for you as well.
This is exactly what we do. Mm-hmm.
Yeah.
This example, again, without reading it to you, if there's purpose with the loan, if we can make sense as to why this borrower needs 100,000 cash out. I mean, obviously we're going to see 50,000 in credit cards in the savings. A refinance, a cash out transaction in our world, I guess any world, but particularly our world, if we can make sense of the transaction, if there's good purpose with the loan, that's the real core of lending and common sense lending. And that's what we do here at Home Express.
Great. Thanks, Dave. All right. We're coming up to 30 minutes. I'll just touch briefly on non-delegated. And this is it. If you're in, an office that, you do have some correspondent channels, we have no carve outs in our programs. If you go non-delegated, And so if you like to have that and us be the investor, we'd love to talk to you on that, right? So you can give me a call. I'm gonna have my contact in there. So so I go through this. I always want to put it out because that's been expanded. We've seen a lot of our clients and partners say, "Hey, I love what you do, but I'd like to be the lender on these and kind of have your programs be as an investor on this." And yes, we do that. We've really kind of grown that business up, and we'd love to have you partner with us on that level if that's something that you do or looking at doing in the future. And so I got some steps here, but the biggest thing is just give me a call, right? Or give me an email. We'll set you up and kind of go through the program with you. So with that, Albert, let's take some questions from the audience here.
Absolutely, Mr. Grider. So we have a question right here from Don. He says it's for business purpose loans, but it says, can borrower do cash out on investment property and use the funds to pay off debt?
See, now this goes in. So that debt, when I look at it like a debt, right on it, that debt, is it business or is it personal debt? So if when you look at the credit report, it's a Visa card, it's this or that or auto loan. You really have to look at that. That's going to be looking more so like consumer purpose, right? And so if they're using it for consumer purpose, that's really you got to define. That would be a TRID loan. But keep in mind that the percentage of it matters, right? So it's 50% or more plus $1 needs to be used for business purpose. Underneath that, yes, they can, right? So you can do that. So it's the percentage of the cash out being used for business purpose to be on the DSCR program,
Yeah,
meaning no
he
income
had
dollars.
yeah, Don added a credit card. So it looks like credit card debt that want to pay
Yeah,
off.
credit card debt. If you're paying those off, that would be typically a consumer purpose loan. You have to afford TRID, right? So we can still do that deal on the non-owner and refinance it, but it'd have to be a DTI loan.
How would I know if they told me it was for business purpose?
You don't. Again, we really don't know, but all the documentation you come through on our disclosures and they sign, they attest to it with our loan documents. So you don't know, right? I'm just saying if you do know, okay, that's the way you need to go. But a lot of them don't. But this borrower is going to attest that it's going to be used for business purpose. They're actually a document they sign, on their disclosures, and it's signing that they're testing that's going to be used for business purpose.
We had, if I could throw an answer into to him, we had a loan 5 or 6 weeks ago, and that broker was able to demonstrate that the 40 whatever thousand that he had racked up on his credit card bills actually were used to remodel the rental property. And so we looked long and hard at doing it that way because it really was a business expense, even though we were paying a consumer card. So as long as we can take a look at papering that and really covering ourselves, CFPB wise, et cetera, that's something that we could dig into as long as you all are willing to dig into it. We took a look at that and solved the problem. So,
Yep, good point, Dave.
mm-hmm.
Nathan is asking, is there a recording of this video? I came in late. Could I get a recording of this? Yes, Nate. A copy of this recording is we post it as well on our website, as well as we will send you an email with a copy of this deck and a copy of the recording that way. And obviously, if you have any additional questions, Nate, you can always reach out to Mr. Grider or to your assigned account executive, and we'll be more than happy to take care of any questions for you. Fadia just added, we also asked for a letter of explanation for the reason for the cash out, kind of going back to what Don was saying, or Don was saying.
Because it is a condition, right? So, and it's, I haven't seen any issues with it, right? But if something sticks out to you, you know what it is, and you kind of put it in the right program.
So, sticking with DSCR, so we have a question here. On a DSCR loan with 2 borrowers, whose credit score do you use, Mr. Grider?
You use the higher. We can
Excellent.
use the higher score on that application on DSCR, right? So if you look at the consumer purpose, I'll kind of expand on it, right, on the differences. That's a great question, but on consumer purpose, we use the middle score of the higher earner. Right. And so that's important because there's a lot of cases, if you go agency, you got to use the middle score of the lowest, lowest score, right? So it doesn't matter who earns most money. You come to a non-QM, we use the middle score of the highest earner. And that could put you in a better rate, better LTV, all those types of things, right? So kind of keep that in mind. So if you got a scenario like that, when one scores lower, higher earner makes that. But on DSCR, it's not an income file, so we use the higher score.
And it's staying with that. It looks like this. They want to know what's the max comp that we could charge on that a broker can charge on DSCR loans.
Yeah, we got lots of flexibilities with that, but you can earn up to 5 points on DSCR, or I'll call it the business purpose, okay? But if you're signed up with us for lender paid, it can actually be a variable lender paid comp on it too. So you can choose what much you're going to do borrower paid and how much you want on lender paid, but you can go all the way up to 5. I don't see a lot of 5s just because competition is out there. But the good news is you got flexibility on how that comp is done. So if they want more cash out, you can make a little bit more on the lender paid side, or if they want a better rate, you can go down to the borrower paid, those type of things. So you have a tremendous amount of flexibility on the cash out pricing, all those type of things with that client to kind of match that up and tailor that loan to that borrower's needs.
And
touch on the dual comp too, Dave. That's something that's
what I'm
rising in
talking about.
popularity too. Okay.
Yep.
we have a question just came in. Lowest loan amount on DSCR, and can you blanket properties?
Those are great questions. Our lowest loan amount is 100,000. Okay. And we do not have blanket loans available yet. I say yet, maybe in the future.
Awesome. Thank you for that, Mr. Grider. Another question is, what are the maximum cash out consumer and DSCR loan amounts?
Right. So loan amounts on consumer, again, the LTV is going to be cut back, but we go all the way up to 4 million on loan amounts on consumer purpose, on business purpose to 2.5. And could there be a case for doing more? Again, we're a true lender, so kind of tell us what you're looking for. We're not going to do a $10 million loan for sure, right? You go to the business purpose. Maybe it's a 4-unit in San Jose, and it's really nice. And shoot, it's a $3 million loan. We'd consider that, right? So it really is we're a make sense lender. That's the big thing we do. It's common sense. What do you have, and let us help solution that. Our AEs are highly trained, man. They do a lot of training here, right? 2 weeks even before they start, and it's weekly ongoing training, so they know how to structure your deal. They're very competent and very responsive to anything that you have out there.
Awesome. Thank you for that, Mr. Grider. That seems to be all of the questions that we currently have at the time, Mr. Grider. So if maybe you wanted to wrap it up with some closing words, sir.
Well, great. Well, thank you guys for attending. Man, this has been a really good year so far. I'm hoping everybody's improved their volume this year. And we're hoping to partner with all of you as we're going forward in 2026 and this last few months here, and wishing you all a great October. I can't thank you guys enough for partnering with us, and appreciate you all. Reach out to me anytime. You have my contact information there. Love to hear from you.
Awesome. Mr. Nelson, any closing words before we let everyone go, sir?
No. As usual, I just wanted to say as far as these cash out refinances go, if there's good purpose with the loan, we're going to find a way to make it. We're on the same pay plan that all you guys are on, is that we want to make volume too. We want to produce volume, and we want to help you guys do that. So that's my word.
Awesome. Thank you for attending, everyone. Bye, everybody.